All right, hello guys, glad to have you on board again today. We're going to introduce volatility this week around, but first of all, just a quick recap to summarize where we are in terms of S&P 500. Also remember that we are still currently trading in this weekly context. Remember, if you have a look at this future based CFD contract in here, we just have gone context to context without reversing it. Remember, if we have a look at the cash index instead, which seems to be more reliable on my end, you can see in here that we have reversed this context. So no shit Sherlock. All that tells us is that for now and until further notice, we have a resistance, low risk area, third range boundary type in the weekly chart reference. Okay, that being said, that means we can trade this area with short-term speculative flows in the H1 time frame. Okay, that's the thing we know. So for now and until we break out of this area, we are only potentially looking for bearish flow sequences. The first one has played in here there. Okay, first bearish flow in here. You can see the context falling below the moving average, followed by a third range boundary, and you could have been able to trade both the moving average in here and the Bollinger Band area. All right, pretty simple. Second flow has been in here, same story, delayed third range boundary in here. That means the bears probably have taken their stops their profits in here as they break the previous high points. Okay, that's pretty damn straightforward. And then came a final potential third flow in here, very close to the Bollinger Band, but I couldn't find this one personally. And here came the third flow, absolute master V-shaped reverse in here. That means the bears have been stopped out of their trades. They entered in here, they put it at break even, and basically they've been stopped at break even in a violent V-shaped reverse, lots of gaps. So very, very violent type reversal for those traders. Okay, so that's really the way it's gone. It went very, very simple in my humble opinion, but we had a nice set of three flows, and like we stated, out of this, well, there's nothing you can do but just to let it behave. Okay, right now we're still in the same weekly area, which means we'll start, for flows you really want to trade intraday with futures quotations. Okay, so have a look at this one, but the sequence is pretty much exactly the same. Okay, exactly the same. So what we have in here was still in this big weekly area. So in terms of S&P 500, we're still waiting for the new sequence to start itself. Remember that, okay, in this sequence, we need to wait for two consecutive bullish flows, okay? For now, we've had just one. Remember, this is just a single big, massive bullish flow. So this, if it goes down, okay, gonna have to be at least a bearish flow. Okay, so that means now remember, both the prices falling and the moving average should also be in the same direction. Okay, there's no flow if the moving average is still rising. So if for whatever reason here we were to go violently to the downside, and if you would see the resistant context falling below the moving average just can't still be rising. Remember, the moving average has to be either flat or falling to consider that the first flow has happened. So the likelihood of a first flow in here is still pretty damn low at the current given time due to the fact that we have a solidly rising moving average. On top of this, there is an alternate sequence, is to say, well, if you want to trade bearish, you need a first flow. And remember, normally, as a first sequence is played itself, we need to have two consecutive bullish flows. So I'll be very, very conservative now into looking at bearish flows now. The other potentiality is to make new highs. Remember, if we make new highs, then we start over a new sequence. And there we can have a first flow. We don't trade it, okay? We wait for retracement and we trade the second flow, and the third one is always at the Bollinger Band. Okay, so that's really the way it goes. If we can play that sequence efficiently, very efficiently, to me, there are two options. Either we let the market consolidate, and then we wait for a second bullish flow. And I mean, this one can go very, very deep, and it can then retrace. All that matters is we have two bullish flows. When I had those two bullish flows, I'll be ready to start another bearish sequence. Okay, so that's really what's in this paper, okay? Yeah, this one. So always remember, you have a set of rules, whether you like them or not. This is the way you should apply consistently. And if you ever break the rules for whatever reason you think are justifiable, they are not. Okay, so that's clearly that when you had a set of three flows out of a low risk area, okay, you're gonna have to let two consecutive corrective flows to let the market breathe in before you actually keep on persisting, starting all over again. Okay, that's really the way to go. It's not easy, any simpler than that. Okay, Otherwise, you're going to have to go back to the low risk area and make a new low to start a new sequence. So these are the two options we're in now for the S&P 500. Either we go higher and we break the previous high point to start another sequence, and as we make new highs, you're going to wait for a first bearish flow. Don't try to trade it, okay? That's the way to go. Option number two, you let this first flow terminate itself, okay? We clearly had it. I mean, if you have a look at it in a reference context, we clearly have seen the moving average falling below the context for quite some time there, by the way. It's really a strong first flow we've had there. We need to let correct and let a second moment in which, once again, I want to see the context crossing above the rising or flat moving average. That means, first of all, the moving average is to collide, to collapse in here, prices as well, and then we need to see a second type of recovery. And only after this, I'll be ready to trade a second set of bearish flows only. So two options, either we start falling and then we wait for another recovery after starting to trade again, or we wait for new highs and to break the previous high points, and in that sense we'll be ready to start trading again. This is all there is now for the S&P 500. It might sound a lot complicated to you, but it's just applying the goddamn rules. I mean, anything else you do but what I just said is breaking the rules. So the rules are simple. Just pull them against the real markets and just try to figure out what you can do, and the rest is just none of your concern, okay? So right now the only things you can do is reset the sequence by making a new high or waiting to have a second bullish corrective flow in order to start another three-step sequence, okay? That's really the way to go. If you don't let the market breathe, you're just going to try rushing into whatever trade. That just doesn't make sense, okay? For now, we've had just one single corrective flow. You need to have a second one. Okay, it's really, really the way it goes. And otherwise, just go and wait until we make new highs. All right? Don't fight against the market, folks. When it comes to cryptocurrencies, well, same old story. I'm going to go real quick. Those who are fighting against Bitcoin for whatever reason there is, I don't understand that. We're still very far from making a third range boundary. Also remember that the last part of the flow sequence, we're in flow number 3. So, of course, if you want to take partial profits, you can definitely do so. We've mentioned that. Partial profits only. If you're taking all the profits too soon, well, it's just a stupid thing. Remember, flows can go way longer than you'll be patient. When it comes to, instead of solvent. And Ethereum, pretty much the same story. People just say, yeah, Ethereum's underperforming, whatever. I just don't listen to them, okay? We need to break 2134, and once we do that, you will be able to put all those trades at break even. Let them talk. It may take longer, who gives a fuck, okay? So remember, always, always to trade this without any too quick or too slow type assumption stuff, okay? Just let it be. You have a set of rules. Don't take your profits until you get that third range boundary. Don't put your stop at break even until you broke the previous high point. You know the rules. Just cut them and apply them. That's where the way it goes, okay? But aside from this, last week we've introduced the fact that I will finally get to teach you. I mean, we've been trading these flows for more than a year now, so I think you are experienced enough. I mean, for those who've been consistently following for an entire year, I think to try learning the final end of the risk curve, which is trading volatility. But the TLDR in here is the reason why I teach that at the last end of these educational series is because, well, people generally tend to take it the other way around and say, well, whatever happens in the short term is easier to navigate, and the lower and the higher you go into the time frames ladder, well, basically that means the harder it goes. I mean, you need to learn macroeconomics and stuff like that, and people just tend to say, well, this is for professionals, this is too complicated, this I can handle. Like volatility, yeah, it's pretty easy. I put Bollinger Bands in the market and it seems to work pretty well, and that means I can trade like a professional, I can make gains in the market. Well, like I've always said, we know for sure that most people lose money in markets. That's just, I mean, look at all the statistics. So most people lose money in the markets, and they all have this same assumption that, well, whatever happens in the long run is for professionals. It's too complicated. It requires knowledge of economics and stuff like that. And whatever short term is something that I can handle. I can just use Bollinger Bands and stuff like that. Well, good luck. Good luck with that. Because if you just connect those two dots, you'll figure out that these guys are just the reason why they're losing. It's because they try to make it simple, and they try to use things they can handle by simply erasing anything else and say, oh yeah, this is too complicated, I can't do that. Well, we know one thing for sure, professionals do make money in markets and retails don't. So that means I would never even try to follow these guys. I know they do things wrong, so don't ever fall for this trap, okay? I'll try to explain today the reason why I think by still being somewhat right, they end up being wrong just because they forget about the assessment. What I try to teach you instead is to do the opposite way around. I teach you those boring stuff which you don't like when I generally tend to say low risk is based on value. Because if you look at this time frames sequence, basically anything sitting on the right is more dependent to value. Like I've always said, primary trends or alternate sequences and stuff like that, they tend to play on larger time frames, not just by magic. It's just because this is where the value moves, and the value just can't move straight line from point A to point B. There are risk managements involved with risk profit takings and stuff like that. And in this context, you would have to understand this, okay? The value that moves in the larger time frames is definitely easier to frame. It just takes longer time series to get to profit from these trades. You can't just margin buy with 10x when your trade is going to take 10 years. You would have to pay 10 years of interest. So whatever happens in the larger time frame is just not cheated game. It's really the value moves in those larger time frame, and the probability to have just speculative stuff moving this value is very limited. So the lowest time frames generally are the larger ones. On the contrary, the short term is really more about volatility or even just order flows. If you're getting somewhat like 15 seconds, this is nothing compared to volatility. In 15 seconds, anything there is just order flow. It's basically you're going to have to trade with order books, okay? So that's really the way to go. It's kind of a sequence of events. You have value in here and you got order flows. These order flows tend to create volatility. This volatility tends to create flow sequence, and flow sequence tend to orchestrate the way value moves through these low risk value areas. Okay, which definitely, if you understand that, you will understand that whoever trades volatility without understanding what's surrounding them is probably the reason why they're wrong. Because what we've learned so far is that you can't trade the flows, okay? Let's study this and say, okay, flows, we know one thing. Flows are time frame -3 from low risk, okay? So the low, I want to make an R. So low risk strategies, let's call them the time frame 0. And we know that the low risk strategy depends. They vary in terms of time frames. This is not up to you to decide. This is really, you have a set of rules to define which is the time frame which the low risk is. There is a sequence that you might know. If this is a trending asset, you should know how mature is this trend. How far are you in the trend, okay? This is really the way to go. You should know on which time frame these low-risk strategies are, and that's it. Once you have that information, you know that you're going to be able to process flow trades 3 time frames below. Like we said earlier, for example, for the S&P 500, we're currently in a resistant third-range boundary type low-risk strategy for the weekly reference, though we can trade the H1 flows. That's just the way it goes, okay? That's really how simple that is. Prior to that, we had the same weekly area on a support context, okay, on the weekly reference charts, and that's just the way it goes, okay? So we were able to trade those flows, plain simple. All right, what we adding into this today is to say, if you have an identifiable low-risk strategy, if you have an identifiable flow sequence 3 time frames below, you're going to be able to fill the gaps with volatility, which is going to play 2 time frames below the flow sequence. So this is 5 time frames below the lower strategy. And here you get a significant gap that says anything that is in the weekly chart will have its flow H1, will have volatility to be traded in 3 minutes. And you can play around this K for 5 time frames, which is very, very important type of gap. And you can still kind of trade all these strategies all at once if you want to. But the reason is, if you don't understand that when you're in a low risk strategy area, trade fucking low risk, okay? And when you're out of this area is where you start trading flows. And when you're out of flow trading, this is where you trade volatility. And this anchor point of dependency is what people generally tend not to understand. And that's the #1 mistake I've seen years over years by retail traders. They try to trade what seems to be easy without understanding the dependencies of the higher time frames. And learn this very, very importantly the hard way, okay? That means First of all, you do the low risk strategy. If you're in a low risk strategy trading area, trade it, god damn it. Even if those trades are weekly or whatever, don't try to trade volatility in a low risk area. That means whatever you're doing in 3-minute time frames is none of your control. These guys in the weekly charts are taking control of these charts, and they will alter all your volatility short-term patterns whatsoever. Though, don't try to play in someone else's game. Try trading the low-risk game, and patience then is due. And when you're out of these areas, flow sequences will start to occur. So once you've taken that low-risk trade, you can fill the gaps by trading flow sequences. Once the flow sequence has started and you start to have a sequence out of it, that means your flow is identifiable, so that means the first flow, you never trade volatility inside this one, guys. Remember, you're probably in the low risk area, so trade low risk. Once you have the first flow, once it made its third range boundary, this means you have sufficient maturity, but you're going to first of all buy the moving average or the Bollinger Band below it, okay? Remember that. When you have a flow trade, take it. Don't try to do anything else, but take the strategy that provides the lowest level of risk in the risk curve. The higher end you go on the left, the more risk you take, okay? Because you depend on whatever happens in the higher time frame. So try to let these guys peak out first to go lower in the low risk curve, in the risk curve, okay? So that's really the way to go. So if you're in here, trade your fucking flow sequence. And then that means whenever the flow sequence is confirmed, where is that? When you break the previous high point is where you're gonna start. So that means here is where you can trade volatility. And I hope you do understand that, okay? Don't trade volatility there. Just let the first flow play its game. Let it provide the entry point for the second entry point in the flow sequence. Once you have that trade confirmed, do fill the gaps with volatility. Starting this is where you can do this, all right? All these areas there are the low risk time frame, trade the fucking weekly chart. And understand that. That's really just how simple that is. If you can't understand these dependencies, you're gonna fall for the traps of all the retails. They trade short term without understanding what's playing in the bigger picture. I want you to think the other way around. First of all, instead of reading from left to right and saying, yeah, this is too complicated, I don't want to learn it, I teach you trading the other way around. I teach you those things that everybody just don't give a fuck about, so that eventually, if you want to trade 3 minutes, you understand those dependencies. If you're not able to figure out where the low risk strategy is, when the low risk tradable areas are, you're going to be unable to figure out the rest. Most importantly, these time frames can shift. Sometimes the low risk strategy will be monthly, sometimes it will go lower one time frame to go weekly, and then it will go monthly again. And if you don't readjust the entire risk curve, you're just going to end up trading the same thing all over again. Meaning, if for whatever reason you decided to go 3 minutes, when actually the rules that I shared with you tell you, well, we've changed, we're now monthly, that means we should be 15 minutes instead. If you don't adjust, and if you don't have a rule set to define where those adjustments are required, well, you're trading random to me. And that's really the thing that I would like you to know. If you're playing this game, you need to have rules for almost everything to just limit as much as you can the probability of you making something you don't control. Making decisions based on whatever it is that you're thinking today, and that's the worst thing to do. The second worst thing to do is to do the same thing all over again by not adjusting to market conditions. Plain simple, trade volatility in 3 minute time frame because you've decided this was the reference time frame for this asset. Truth is, probably 6 to 12 months from now, the time frame will change, you won't, and that means your same old strategic will start to provide far less gains or even provide losses. And that doesn't mean your strategy was good and now it's bad. It just means you failed to adapt. And that's really the #1 mistake people make. Okay? So that out of the way, we can go straight in. Okay? As you understand the risk curve dependencies and you understand that we always read from right to left, though we first of all assess the low risk strategy and we look at the time frame which they play in, and you have to reassess that regularly. The larger time frames, once again, they provide new context each and every quarter or each and every year. So you don't have to do it every day. But remember that every quarter or so, go to the lower strategy, figure out how these evolved, and see if readjustments are needed. If they're not needed, same old game, okay? If you enter in a lower strategy area, trade it. Out of this area, trade the flow. And when the flow sequence is identified and you still want to do thing, wait for the flow sequence to mature. And when it did, trade the volatility in between. All right? That's just as simple as it is. When you are in the second flow, okay, and when this one pulls a third range boundary, let me just go back to Ethereum. Okay? So when you are in the third range boundary of a flow sequence, okay, so basically this one was a delayed third range boundary. So what does that mean? That means, well, in here, those third range boundary areas is where I clearly would like you not to perform the volatility trades. Here's where you take your profits, okay? As a second flow trader, this is where you profit take. So take your profits and don't try to trade too much volatility in these areas. Same story, all this Bollinger Band in here. You can trade the volatility only after you traded your entry first. Okay, in this area, this is where I want you to trade the flow sequence. Okay, trade the risk curve according to what it provides. Okay, when you are in a flow sequence trade, trade this flow sequence. Don't try to trade volatility there. Volatility is what you use to fill all the gaps. So out of these areas where you take your profits and out of these areas where you take new bullish trades for the third flow is where you fulfill the gaps with volatility. Okay? So now let's just give you the rules, because once again, in here, the rules are pretty damn simple, but if you pull it the other way around by using those rules out of their context, you're going to have some problems, okay? So the rules are simple. What you're going to be doing is, in the reference time frame of your sequence, we said that we trade the volatility 2 time frames below. Remember that. So there are 2 options now. Either you're going to go 2 time frames below and use the Bollinger Band provided by the indicator, or plain simple, you just use the Bollinger Band. Remember that in 15-minute chart time frame, your context are 2 time frames above. That means your context will be updated every 4 hours. So you can just stay to the 4-hour chart. Instead of changing in here, just making it easier for you guys. You're going to use the Bollinger Band indicator, plain simple one, okay, and, god damn it, okay, and you're going to use, no, not this one, you're going to use a 2.5 standard deviation. Don't ask me why. The only thing is that, well, try for yourself with 2 and 2.5 and you'll see that 2.5 is better. So that's the way it goes. I haven't decided that one. But it's really simple, okay? So remember the way we go. So long as you have your second flow validated, starting here is where you can do it, okay? So remember, this is the area when we can start doing it. We've broken the previous high point, so we have the green light. Our second flow has started, and we can now fill the gaps with volatility, okay? So here it goes. Standard deviation 2.5, and we wait for a sequence that is fairly easy to understand. The sequence says, first of all, I want to see divergent Bollinger Band. So I want to see the higher Bollinger Band going higher, the lower Bollinger Band going lower, and possibly not just for a couple of candles, okay? You want it to be sustained at least for a few candles. So you have this, and what I want afterwards is the opposite of it. I want to see these 2 Bollinger Bands going in the concentric direction, okay? The higher one goes lower, the lower one goes higher, okay? After expanding, they're now contracting. So you want expansion and contraction for multiple candles in a row, and once you have that, okay, you're going to trade eyes closed all the 2.5 standard deviation prices, okay? That means when we go here, you go ahead, you trade, okay? That's really the way to go. The way to go is pretty simple, okay? Listen, the rules are simple. Don't bend them, don't cheat them, and always trade that with a replay, okay? That means you put yourself in the context of what you were able to see at that time, all right? So here, you know you're trading somewhat at 1761. You know this is clearly, okay, you go ahead. You can, of course, risk manage according to the low risks, the signals you have, okay? You can gather information. In here, well, you had a range breakout who's been pretty much broken across. It's nearing its end. You have absolutely no other signals. If you trade there, well, you're really gonna have to go easy, okay? What that tells you is this: you have no signals. You're trading on the contrarian side of your flow sequence. Remember, the flow sequence is bullish, so when you're taking bearish trades in bullish sequences, you really want to go easy on risk taking. So we tend to say in here, well, you can definitely trade. The strategic rules are validated, and I've never mentioned signals to say no signals, no trade. All I said is no signal, lower risk trade. So really lower the position sizing, okay? It's really the way to go. If you trade there, yeah, definitely don't go with a 2% trade. It's really maximum to me in here going to be a 1% trade due to all the reasons combined. We seriously lack of signal. That means prices could go higher and you'd rather like to have some gas in a tank for this potential second trade. So the answer here is either I don't trade at all or I trade with a very tiny position sizing because I am against the flow sequence size direction. And when it goes to the upside, you'd rather like to buy more than what you sell. Remember, unless you have very good signals suggesting you can sell with a full position. So in here, yeah, very much 1% or 0.5% at best. Okay, remember what we said? So long as you don't, sorry, we haven't said that. Second stage is touching the moving average, okay? So remember, we want to see expansion, then contraction of Bollinger Band, several candles in a row. And then you're going to be trading anytime the market goes close to 2.5 standard deviation. Okay, the signals are optional, but they help you manage your risk and size your positions. So in here, we're still trading at 2.5 standard deviation. Anytime a signal shows up, you go ahead with that, okay? If you didn't already there. And you wait for prices to retrace to the moving average. Once you touch the moving average again is where you're going to put the stop losses above the market top that's been made. In terms of stop loss, when you trade there, okay, you take the average position size of the Bollinger Band and you put it up. That means this is your approximate estimated gain. Don't risk more than what you could gain. So your stop is in here and you don't move that stop loss until we get to the moving average. Okay, so waiting, oh sorry, why? All right, adding new candles, still not. Hey, look at that. Here's where we had our signal, now we have a breakout target. So this definitely is where I would have taken a second trade in this pattern. Now we've broken the moving average is where I can lower my stop loss to the previous market top. Okay, so if you've entered there and there, you say we have an average entry price there, and now your stop is here. Okay, so you have a very, very tiny stop loss. If the market goes there, well, take your stop loss. Don't try to cry, okay? It's really the way to go. It's not going to work 100% of times. And you take your profits when you have the opposite conditions. That means here is where you buy, okay? Though you sell, you profit take, and you buy now. Look at the signals. You have a trend signals in the side of your market context. Well, go with that. Frankly, in here, no questions asked. I would definitely go bullish in here. So you take your profits to the bear side, and now you buy. And that's the way to go. What did you figure out? When you get to crossover the moving average is where you can put your stop loss. Oh, easy one. This one is stop at break even and profit taken. Do you sell there? Yes, of course you do. The signals are great. So frankly, in here, same story. If you sell this area, go real easy on that one, okay? But remember, that's the same story. We had our expansion and contraction, and so long as we stick to this area, volatility is going to be our game. And you can play this game 6-7 times in a row. Of course, the longer you play this game in the same price area, the more dangerous it goes. Because sooner or later, remember, we're going to have to get out of this price area. We can't just stay there forever. But remember, we're in flow sequence. It can't stay longer than you're going to be patient. So remember that. There's no rule saying it's going to happen 3 times, 4 times, 5. No, it's going to randomly vary over time and over flow sequences. So trade it so long as it is. Always remember that when you're selling in a bullish flow, always try to take lower position sizing in the opposite direction. So in here, when you sell, clearly no 2%. We have no signals. We still have that breakout target, which going to be helping us. But clearly in here, it's maximum 1% risk taking when you're selling. You've taken a 2% nice gain. You've taken a 1.5% gain in here to the downside. That's frankly, once again, if you end up being stopped in here by the market breaking higher, you're going to lose some of your gains. But net, the strategy still has been profitable so far. Okay? That really is the way to go. And oh boy, one more trade. So that's really just how it goes. Try to make it dumb and easy on your end. Okay? In here, look at that. We are once again standard deviation 3.5, we have a negative price, okay, and we have absolutely nothing in the buy side. If you take this one, well, boy, you really want to go 0.5%, 1% maximum, okay, so that's really the way to go. And you apply that thing into that same price area, knowing that sooner or later you're going to take a stop loss. Well, as you can see, boom, this one worked again. What do you do with this one to sell? You have absolutely no signals back then. Once again, kind of trend. If you take this one, easy one, 0.5%, best case scenario for the risk taking. But you keep playing that game. Now you're stop at the market top, so pretty much at break even, but not at. So your stop is there and you wait, okay? Oh, another profit taking. That's incredible, right? And what do you do here? No signal, so go easy on that one as well. If you want to trade it, yeah, do it. But like I said, 0.5, 1% risk at best. And oh, yet another profit taking. See, we are at 1, 2, and it just goes on, okay? Sometimes it will be just 3 times, and the fourth will be taking a stop loss, and so on, okay? That's really the way to go. What do you do in here? Absolutely no risk limitation. Well, if you go on that one, like I said, kind of trend, really go easy. Is it going to work? This one, okay, now is your stop is there, okay? And this one is taken down. This one, your stop is taken by the market, okay? So just give it away, and you've taken a tiny stop loss. You probably have traded this area, and you've got stop for what? A few points. So compared to the previous gains you've made, this is just really, really negligible type of stop loss. And now that you've taken this stop loss, well, just let it behave, okay? You always have normally bought this area. So that means the market's going up, you're making gains, you just kind of filled the gap and the blanks by trading volatility. So that's the way it goes. If you just get bored by just how long the flow sequence takes, well, you can do this. You can fill the gaps with volatility. Remember, these are 2 different strategy types, but there are dependencies between them. All right? And so long as you can understand all this, you really, really will trade much more efficiently than people who forget about those dependencies or just blindly just push them away and saying this is too complicated. As you can see, this is kind of complicated, but it is not impossible to figure out. Learning low risk strategy, well, not that complicated afterwards. When it comes to flow sequence, yeah, it is requiring some efforts to learn, but it's not necessarily something you can't do. It's doable. And the volatility, well, the rules are even simple, but the thing is that if you apply those rules out of their reference context, forgetting about the dependencies, it simply doesn't work. And this isn't managed. Once again, take those rules. Take the context I taught you. Like, do figure out the lowest strategy time frame. Just figure out the sequence of flow. And once you see that sequence of flow at play, apply the volatility pattern I just told you. And see for yourself, okay? Remember that you need to do it somewhat like 50 times, 50 trades at least, to try figuring out somewhat of a statistical context in here, okay? There's nothing statistic below 50 times, okay? Below 50 times, just luck. So if you want to remove luck from the equation, figure out those rules. If some of the rules feels unclear to you for whatever reason, just go into the Discord and ask, okay? So long as the rules are clear to you, try to apply them for yourself on replay, okay? Look at what the market provided in the reference context you had back then. Try to use this replay function and see for yourself if it was profitable or not. The rules are simple. They're here, they can't be broken. Either you apply them the way they are or you break them. If you've managed to apply them correctly for 50 trades in a row and managed to lose some money, I'm very curious to see what the market was providing at that time. So clearly, if you take a sequence of 50 trades that lose money with these strategies, well, really take them, show them to me, and I'll be very curious to see that to happen. Otherwise, once again, this isn't magic. It's just that you have removed all of personal assumption, which is the #1 mistake that many people make out there. The second thing is that you've learned to frame your decisions in a context. You understand those dependencies, and if you can do that correctly, normally it works just fine. Okay? That being said, that doesn't mean this strategy is the best one. No, it's just one of so many strategies that work. But if there's one thing I've learned throughout the times is that all the people that I've seen consistently making money over years, okay, though not the random lucky guys on YouTube who just pretend to be billionaires and so on. No, really the guys who've been consistently making money over years. They all have different strategies. But we all have those same things. We might call the things differently. We might say this instead of that, or that instead of that. That's really the way to go. We all have the same kind of framework. We do understand those dependencies of time frames, coming from the higher time frames down and rippling down to the lower time frames. Certainly not the other way around. The shorter time frames don't influence the longer time frames. It's certainly the opposite way around. So don't be dumb enough to think that you can trade volatility without understanding the things that sits on top of it. It's really not how it goes. Learn the low risk first and then ripple down through the risk curve. It's really the way to do it efficiently. Out of this, it means the professional traders I've always came across have all got some serious set of rules. Anybody who just says, yeah, learn my strategy, it's pretty damn simple. I mean, just erase these guys. You know for sure they're not professionals. Every people I've been coming across have very complex sets of rules. They have inter-time frame dependencies, and they have different structure for different time frames. And that's exactly what I'm teaching you as well. That doesn't mean I found that the Saint Graal of trading. It just means I have something, and if I've looked at some other professional traders, they seem to have similar things, called differently, using different indicators or whatsoever, but they do have all those dependencies. Now that you have them all, you all wanted to trade short term, all right? I know that because, like I said, I know beginner trading biases. You want to go short term because of the reasons we explained previously. You want to go there because you feel like this is where you can control things, because this is where the strategies are pretty damn simple. What we've explained today is kind of fucking simple, okay? You just put a 2.5 standard deviation bull in Japan and it feels like magic. Well, it feels like magic because you figured out all the fucking dependencies first. And those dependencies give you a time-limited offer. And if you trade those 2.5 standard deviation away from these safe areas to do it, you'll see it doesn't work. So do it for yourself. Take those rules, apply them, do your fucking low risk assessment, figure out the flow sequence pattern and its maturity. And when you're in this sweet spot where you can do this volatility stuff, if you do it there, it works. If you do it all the time, everywhere, it doesn't work. And also understand that when the low risk strategy time frame switches to another one, your volatility time frame will switch as well. If you try to trade volatility outside of flow sequence, good luck with that. It's just randomness, all right? So remember that in the giant chaos that the low risk time frame is, there are some areas of calm. There are some areas in which chaos clearly isn't at play. There are some structures in those areas. If you figure out how to identify them and efficiently navigate them when they're there, and efficiently accept not to do it when you're not there, you're going to be a successful trader. All right? It takes some time to process all of this. I really agree with that. That's the reason why I've always made it simple to say it's going to be long. It's not going to be easy. Accept that, embrace that. If there was an easy way to make money in the markets, we would all know that. All right? So that being said, I'm going to leave you guys with that today. It's a very long podcast. I'm sorry about that, but you really wanted these volatility stuff. Now I gave it to you, but once again, trade very carefully. Remember that if you ever forget about the dependencies, you're going to go into troubles, okay? That's where the complexity is hidden. A simple set of rules is always hiding quite some complexities. And if you figure out any other way to make money with simple rules, well, I'm really listening to you. But forget me not to say that I've seen many people pretending to do this over the years. All I've seen so far is that either they're lying or they're hiding all the complexities. So that's the way to go. I'm going to leave you guys with that. See you on Monday for the low risk strategy update. And, well, see you next week as well for flow update. And from time to time, we're going to introduce those volatility patterns when they do have time to play in those flow sequence. All right? So that's simple as that. We do longer term assessment each and every Monday. We do those shorter term assessment, flow sequences, and sometime we're going to put the volatility trades in those same podcasts when the reference context for such a thing will be there. All right? So starting in last year, for more than a year now, we've been doing flows only. For the year ahead, we're going to do flows and volatility when the right time is for those volatility patterns to be traded, all in the same weekly reference context. That being said, see you guys for the last time. Bye-bye.